Okay, in our last video, we talked about creating the income statement. The next step is to create the statement of owner's equity. So you can see the income statement we created is right here. And our next step, as I said, is to create the owner's equity for this company, create the statement of owner's equity. So what things affect the owner's equity? Their capital, their revenues and expenses, and their withdrawals. These are the items that are part of owner's equity. So we already know capital is the primary owner's equity account. These are really sub-accounts or temporary accounts of owner's equity. So every time that we have a transaction, we don't have to put it in the capital account. We can create these temporary accounts to hold this information so it's easier to trace and organize. But when we do our balance sheet at the end of the period, we want to show how these things affected our capital. So we do the income statement to show our profitability. Our next step is to do the statement of owner's equity, which is a simpler statement. You can see there's only one column. I know your book shows you that there's two, but you can do it with one column. And what we're trying to figure out is what is the capital at the end of the period, and what will they start with in the next period? It's not going to be this. This is what they started with, that $38,900. That's what they started December with. So that's our beginning capital. And that's $38,900. Again, what affects owner's equity? What affects capital? Revenues, expenses. We don't need to redo all this in this statement. We've already done that. All we need is the net figure. So Dynaclean had net income, so that's going to add to their capital, right? That's going to increase their owner's equity. Okay? Now, when an owner takes assets out, usually cash or withdrawals, it has the effect of decreasing the owner's equity, which, remember, is represented primarily by the owner's capital account. Again, notice withdrawals is not on this because it's not an expense. It's not something that is part of the cost of earning revenue. It's simply the owner taking money out for their own use. So that's going to be a reduction in our capital. That's going to have a negative effect on the owner's capital. So the ending capital for December, which will be the beginning capital for January, will be the $38,900 plus the $74 minus the $9,500. Now, since we express this as a negative, we have to add it. So we can use the auto sum here to do that. And we can see their new capital is $36,800, which is less than what they started with. And the reason for that is because the withdrawals are higher than the net income. Not a very good financial management strategy. Okay, but that's going to be the capital that they end with and that they're going to start January. Okay, so we're going to do a thick bottom border here and a double bottom border here. Okay, and that's the statement of owner's equity. There are ratios you can do on this, but we're not going to get into those now. In the next video, we will look at the balance sheet. Thank you for your attention.